Good afternoon, everybody. It's Thursday, November 20th. Wow, this week is going fast. So today we got a whole slew of information we've been waiting on. Let's kind of dive into it. After hours yesterday, we had NVIDIA come out and blow away the numbers. They beat on the top line, bottom line, and future projections. So the stock jumped. And it's just real interesting when you start diving into this. All these numbers that they're showing is on preliminary orders or expected orders from companies. The real question that's being asked now is what's the financial health of these companies that are placing all these orders for chips? And will at some point that flow into NVIDIA's number and start to slow it down? Now, this morning in pre-market, NVIDIA was up 6.5%. But wow, now we're sitting, in the afternoon, and it's down 2.9%. That's a pretty decent swing for this, to be going on with these numbers. It's very interesting to watch. The Dow started up in the positive territory, a few hundred. Now we're sitting at minus 305. So this stuff can turn on a dime. The big piece that was coming out today, besides NVIDIA numbers, was the BLS September jobs report. So they showed that there were 119,000 jobs created. The market was expecting a 50,000 number. So it was definitely a beat, but we'll get deeper into the numbers here because there were two negative revisions to the previous 2 months. July was brought down by 7,000 to bring it to 72,000, and August was revised down by a pretty big number, 26,000. That brought it to a negative 4,000. Now, there's still one more revision to come from August. And based on the pattern we've been seeing, in previous reports, that's probably going to be a negative revision also. So with today's figure, the average amount of jobs created over the last 5 months is 38,600. It's definitely on the weak side. The birth death model has been, as we've talked about, the main culprit for these big revisions back and forth over the last many, many, many years. And we become accustomed to seeing it. But come January, the BLS has announced that they're going to change the methodology on that report. It will not show up, though, until the February jobs report from the January numbers. So that's potentially very good news to have accurate data coming out without these big numbers varying, month after month down the line. Now, when we break the numbers down, almost all the jobs came from healthcare and social assistance and leisure and hospitality. They've just been continuing to be that engine. Now, government did add some jobs also. Now, there's two aspects to the unemployment report. One's the household survey. One's the establishment, the headline survey, which we got. The other is the household survey, which we'll break down here. That showed that there were 251,000 jobs gained, but it is a volatile figure. And because the labor force increased by just shy of 500,000 people, the unemployment rate actually increased from 4.3 to 4.4%. Now, and that's mainly because the number of people increased by 219,000 in the report. But when we look at the actual raw number of unemployment calculation, it came in at 4.44%. So 6/100ths off of coming in at 4.5%. So you can see we're right on that precipice of coming in at a 4.5% unemployment rate. There were 673,000 full-time jobs gained and 573,000 part-time jobs lost. Now, it just doesn't quite jive, however, with the average hours per week worked, which was unchanged at 34.2. If all the full-time jobs were gained and part-time jobs lost, you'd expect the average work week to rise. Something that helped bonds was the average hourly earnings figure only rose 0.2%, so it helped with potential wage pressure. So it doesn't seem, based on all this, we're not going to get the December report for November until after the next Fed meeting. So combined with this number and the hawkish report we got from the Fed meeting that we'll go over in just a minute from last month, we're probably not going to get a rate cut in December. Now, those Fed minutes on the October 29th meeting that were released yesterday afternoon, the overall tone was definitely more hawkish than even what the market planned on. Most of the Fed members felt that policy was still restrictive and that the Fed needed to cut more to get to neutral. But the timing of when that would happen was the main conversation and issue. There was heavy debate regarding a potential December 10th cut. And as of October 29th, when the minutes are from, the majority were not in favor of cutting and highlighted inflation concerns. And I think many of the members have gotten more hawkish since that meeting. Now, we also had Quality rental price report come out. They showed that single-family rent report prices fell 1.3% in September. Year over year, rents are up just 1%, which is a deceleration from last month's report of a year over year run rate of 1.4%. Multifamily rents are down roughly 2.5% year over year. At some point, we're going to continue to see that flow through and gain steam into the CPI and PCE reports because housing and shelter costs are such a big part of that number. Existing home sales, which measured closings from the previous month, rose 1.2% to an annualized pace of 4.10 million, slightly better than what the market had forecasted. And year over year, sales were up 1.7%. Now, this report reflects closings, like we talked about, in October, which means consumers were shopping and signing contracts late August and September. That means that the drop we saw in mortgage rates in September hadn't flowed through and been realized into these numbers just yet. So most likely, the next 2 months reports are going to show more activity. It's what we've been talking about with rates coming down, volume is going up, competition is going up. Median home price increased 0.7% to 415,200, and there were 1.52 million units for sale at the end of October. That was down 0.7 from September, but up 11% from last year. So right now, nationally, we're sitting at 4.4 months of inventory, still kind of tight because a normalized market is defined as about 4.6 months. Homes have been staying on the market a little bit longer. That ticked up from 33 days to 34 days in September. And 19% of homes sold above list price, same figure as the previous month. Remember, those are before the rate drop when we had started to see more competition coming in the market. Cash buyers made up 29% of the market. That was up from 27%. Investors dropped from 17% to 16%. First-time buyers accounted for 32%. They made a little bit of a comeback because that mark was sitting at 30% in the previous report. We also got jobless claims. Initial claims dropped 8,000 to 220,000, but continuing claims continued to be a challenge. That rose 28,000 to 1.94 million. Figure continues to remain just under 2 million, which is the high water mark since 2021. We're seeing the mortgage-backed securities up 8 basis points today. 10-year Treasury is at 4.098. We're down 3 basis points. We did have a little bit of concern with NVIDIA coming in as strong as it did, and unemployment numbers coming in a little bit healthier than what we expected. Thought we might see some upward pressure on that. It's nice to see that we didn't. Give us a call, 616-293-2189. We'll help you get pre-approved, go through programs and options, help you understand what the market is doing. 616-293-2189. The Market Update Desk, your original singular market news source for Western Michigan. Have a great day.